And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning and welcome to The Real Investment Show. It's the second best day of the week. Of course, that means Michael Lebowitz joining me this morning. We're going to talk a little bit about dividend investing this morning. We got a very interesting email question earlier this week talking about, well, how do you pick dividend stocks, right? It's a good question. So Mike and I will just kind of go through kind of the fundamentals of stock picking today a little bit and talk about dividends. We also got to talk about the Fed. The Jackson Hole Summit right around the corner, then the next Fed meeting. Of course, we had CPI out yesterday. That came in right on the screws, right? So again, we talked yesterday morning that number could be higher or lower because of just, kind of recent trends and data. But it came in exactly at 0.2% at the headline, and markets took that favorably. Again, the overall inflation rate fell to 2.9. So that is certainly heading towards the Fed's target. Remember that the Fed had often said that, where they want to be in terms of starting to cut rates is seeing a ongoing trend of declining inflation, and that's what they've been getting as of late. So that's going to set up these potential for rate cuts. In fact, right now, B of A, their professional investors or institutional investors, are now expecting 31% of them now expect 4 rate cuts by the end of this year. 26% expect more than 4. So we're starting to see a kind of a lean towards more aggressive Fed rate cuts. Now, as we talked about before, that's not typically great for stocks because when the Fed's cutting rates very aggressively, that often means that the economy is slowing down a whole lot more than kind of what people are currently expecting, right? So the economy's great right now, everything's fine, seems to be, markets are doing well. But again, if the Fed's cutting rates aggressively, what are they trying to tell you, right? And that's how markets tend to react to that. Today, we also have retail sales. So one of the big drivers for the economy, of course, is retail sales, and that's 40%. Retail sales make up roughly about 40% of the personal consumption expenditures, which is the 70% weighting of the GDP calculation. So you cannot dismiss retail sales today and its importance into the overall outlook of where the economy is going over the course of the next few months. Again, we've seen a lot of data out recently that suggests that retail consumers are really starting to get pinched a bit. If you take a look at delinquency rates for credit cards and auto loans, those have been rising sharply. So again, when people start missing credit card payments, not making their minimum payments, missing their car notes, that's starting to tell you that things are getting a bit tough at home in terms of paying the bills. Of course, we've known this for a while, but now we're starting to see this actually translate into the actual data for consumers. So again, retail sales will be important today. Seasonal adjustments are going to be the big factor for retail sales today. So if we have a really strong retail sales report, a lot of that's likely going to be seasonal adjustments due to back to school shopping, those type of things. So we'll have to look kind of below the headlines of the data. No matter what the data comes out today, look behind the headlines, right? Just don't take that number at face value because again, July and August tend to have very big seasonal adjustments to them. So again, we'll see how those numbers play out today, but that will have an impact on the markets in terms of those numbers. So if those numbers come in really, really weak today, that could have an impact on the market one way or the other. Again, a lot of this is going to feed into expectations of whether or not the Fed's going to cut rates. The worse the data gets, right, the more that people think the Fed will cut rates. They think that's going to be good for stocks. Historically, that hasn't been. But we'll talk some more about that this morning with Michael Lebowitz. Let's do a trip around the markets this morning because there's been a lot of action here really over the last 5, 6, 7 days. So here's what you need to know before the bell this morning. We've had a 4.5% rally over the course of the last 5 days. It's been one heck of a good rally here for markets. We've cleared the 100. We talked a little bit about this yesterday. We've cleared the 100-day. We cleared the 20-day. We are right into the 50-day moving average yesterday, stalled there. That's where we're going to open up this morning with markets looking to challenge this 50-day moving average. We are back on a buy signal on the MACD. So again, that's going to provide some buying impetus for the markets. That'll help support asset prices here in the near term. And we're not exceedingly overbought. We're starting to move back up into short-term overbought conditions, but we're not there yet. So again, there's still some fuel here to push this market higher. But this has been a really, really strong rally ever since last, not this past Monday, but the Monday before last. That sell-off and that whole concern about the Japanese yen, the yen carry trade. We had 2 days where the markets just gap lower. It looked like this market was really starting to peel off. And then magically, liquidity came back to the markets and we've had this very nice rally. So again, this is all fine right now. The bullish trend still very much intact. If we can clear the 50-day moving average and stay above that through Friday, this correction's over, at least for now. Now, having said that, though, one thing driving this market rally right now is share buybacks. This has been a big part of this, and that's why you've seen the big tech companies in particular leading the charge here over the last few days. That window starts to close again September the 5th. So buybacks are going to start coming back out of the market because we start reporting earnings in October. So that window will close around September the 5th. So we're going to start losing that buying power right at the time that we began the historically, seasonally, kind of that seasonal period where markets tend to de-risk going into the election. And again, as we talked about before, given this year is likely going to be a contentious election, we could very well see that de-risking start to occur late September, early October, at a time where buybacks are closing out of the window. Those windows are closing out for buybacks. So that could potentially provide another flashpoint for another correction or another pickup in volatility heading into the election. On the bond side of the portfolio, of course, yields had rallied up a bit. We talked about previously a couple of weeks ago that it was when yields had really dropped sharply because of that yen carry trade blow-up. We said you really can't buy bonds here because they're too overbought. Yields rallied back from that a bit. Again, that wasn't surprising, but of course with the latest CPI, PPI reports and expectations the Fed's going to cut rates, yields have started to come back down again. So we had a nice reflexive rally. Yields are oversold. This is inverted, right? So when yields are oversold, they're actually overbought. So again, I would expect here over the next few days to see yields kind of rise back up a bit. Again, I wouldn't try to buy bonds right here, right now. They are overbought. Yields are pushing, fairly overbought levels. So expect a bit of a retracement. I wouldn't be surprised to see yields come up to around 4%, but that will probably be a much better buying opportunity versus where yields are right now. Jumping over into crude oil, this has been kind of an interesting thing in the crude oil space. Crude's actually had a decent rally here over the last couple of weeks. There's a tremendous amount of shorts out there on oil prices right now. So again, any type of issue that kind of sparks concern over oil supply, there's a lot of shorts that are going to have to be covered if oil prices rise. So there is a potential short-term risk of higher oil prices, particularly as we move later into September, October, going into the election. But again, we're on a buy signal for oil prices. This will, of course, translate into a better positioning for energy stocks as well. And energy's been doing okay. They haven't been doing fantastic. But again, oil prices drive what goes on in energy stocks because of that input of the commodity price. And again, you've seen that rally in oil prices. You've seen a rally in energy stocks in general. This is XLE, which is the energy ETF. But again, I think there's a decent setup here if we get some type of activity. But again, be a little cautious with energy exposure. It's on a sell signal right now. You've got a potential here, kind of this kind of downward trend in the markets. So lower energy prices and lower oil stock prices are certainly not out of the question. So be cautious in that space for right now. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive. as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Michael Lebowitz joining me, of course. Hey, Mike, how are you doing?
I'm doing great. How are you?
Good. So, kind of some interesting data out yesterday. Of course, we had PPI on Tuesday, and then yesterday we had CPI. CPI came in right on line. 0.2 at the headline, 0.2 at the core. Pretty much everything as expected in terms of the actual CPI report. And look, and just very quickly, I was driving into the office this morning to do the show, and I was listening to a radio station, and they were, kind of making the comments that most people make. It's like, CPI was X yesterday. It's only 2.9%. Apparently, these people never buy groceries and never go to the store because they have no idea what's going on with real inflation. Look, Mike and I understand that. But again, our personal experiences in inflation has nothing to do with the financial markets and government reports, right? And all the market cares about is the government reports. So you may not agree with the inflation data. And again, you have to remember that this is an aggregate assumption, right, about inflation across the entire country. Depending on where you live, your inflation is very different than where somebody else lives. For instance, if you live in California, gas prices suck. Their gas prices are not bad in Texas, right? Our gas prices are about half the rate of what they are in California. Where Mike lives in hillbilly liberal land,
Hillbilly.
Their inflation on housing and other stuff there is much higher than it is in say, Texas. So inflation is very different from region to region, and from income level to income level. Inflation is very different. And so our experience with inflation is important, and I'm not dismissing that. I'm not saying that your experience with inflation is wrong, because it is your experience with inflation. But that's not your experience with inflation, my experience with inflation, Mike's experience with inflation has nothing to do with what the financial markets look at. And all the financial markets care about is the government data. Whether you agree with it or not, that's what bonds are going to respond to. That's what stocks are going to respond to. That's what forecasts are going to be built on for earnings growth and expectations for earnings growth. That all comes from the government data. So again, as investors, and that's why you're listening to this show at the crack of dawn this morning, is because we're trying to manage money. So we have to separate our personal experiences from the data and look at the data that the market cares about. And we may not agree with that, right? That's okay. There's nothing wrong with disagreeing with it, but all the market's going to care about is what the government reports. So having said that axiom, because I know there's y'all in the chat are going to go crazy this morning as we talk about CPI. But CPI came in right on the screws yesterday, 2.9%, kind of at the headline. So this is going to kind of cement in potentially the Fed cutting rates. They had, as I mentioned in the opening, they have been saying for over the last 18 months that what they're looking for is a consistent trend in inflation to get them into a position to cut rates. And the evidence is now there that the trend for inflation is lower. They're beginning to approach their target rate of 2%, which may take another couple of years to get there. But that data yesterday certainly supported their positioning of starting to cut rates in potentially September. What do you think?
Yeah, they're going to cut in September. I think, assuming the next round of reports isn't crazy, it's pretty much a done deal. And you're starting to see the Fed members come out of the woodwork and tell us that they're okay with cutting rates. None of them are gung-ho, notice, but they're all kind of conceding that it's time to start cutting rates. So it's this very conservative rate cutting regime that the Fed appears to be kind of starting on. The inflation topic is really interesting because we as human beings, it's really hard to calculate inflation. First of all, we have stuff stuck in our mindset. So for instance, we're always comparing prices today to where they were pre-pandemic. But when you look at these reports, they're comparing them today to where they were last month or a year ago. And we're not, writing them down and forming spreadsheets and doing the same math. And we're also not buying, like Lance said, we're not buying the same stuff. Used car prices are down double digits. And that's not the government telling us that. The Manheim who runs secondary auctions is telling us the same thing. So you have to take the full the full basket of prices and really do what the BLS is doing. And you may not agree that's 0.2%, but it's also not 5%. So, you take government data with a big grain of salt, but realize the trends and realize that if inflation was running 8% and our wages were running 3%, we'd all be dirt poor. And that's not necessarily happening. So there's a lot of wiggle room between what people think inflation is and what the government thinks it is. But what we do is we look at the trends. Are they declining? Are they stabilizing? Are they rising? And, it's easy to, I'm kind of getting on the government side here, but it's easy to bash the government because there's a lot of warped calculations and seasonal effects and averaging and surveys that go into CPI. But it's an incredibly complicated thing. And at the end of the day, no one can calculate inflation. So like Glenn said, we have to go with what the government says and what we also see in a lot of private surveys that somewhat affirm what the government is telling us.
And again, one of the things that comes up, and again, we did see this yesterday, homeowners equivalent rent rose. So we did see a interesting spike in homeowners equivalent rent yesterday. But that rent calculation jumps all over the place. It's not a steady calculation. We've seen these spikes before, then like the next month they drop again. So again, you've got to be careful with taking one print for 1 month and say, okay, this is, rent was up. That means inflation is going to come roaring back. That's not the way it works. And again, these are, the rents are surveys. Basically, they're calling up Mike and say, Mike, what do you think? You own a house, right? Yeah, I own my house. What do you think you could rent it for? Well, right. If there's been something going on in the month, then he says, yeah, I think I could rent it for, $5,000 a month. And then next month, something happens. Well, I think it's maybe $4,000 now. And so that number jumps all over the place. So you've got to be real careful. And this is really the case with all economic data, is you really have to be careful with 1 month numbers because of seasonal adjustments, because of factors, because of, a state doesn't report some data for 1 month because of some glitch. These numbers can pop all over the place. And this is why it's really important is to look at trends. And this is why Mike and I look at year-over-year rates of growth or 3-month averages or 6-month averages, because what we want to know is what is the trend of the data telling us, because that's much more important than 1 month to the next. Mike?
Yeah, no, that's right. And inflation is such an important part of what the Fed does, what bond yields do, and ultimately a huge driver of our economy because we're so indebted. So having a good handle on inflation is very important. And that's why it's probably the biggest number outside of employment right now, not just for the Fed, but for the market. And it's silly, but if it came in a tenth higher than expected, the market would have sold off. And if it was a tenth lower, the market would have rallied like crazy because of its implications for the Fed. Mm-hmm. So, it's just outright stupid to be a tenth either way based on the millions of inputs that go into that calculation, and the impossibility of getting it right is kind of funny, but that's the world that we're forced to live in and to invest in and to try to make sense of.
Right. But today is important. Again, retail sales. And again, inflation is ultimately going to be a function of economic activity. And as we talked about before, the reason we had that big spike in inflation was because we sent checks to households as we shut down the economy. So we created artificial demand at a time where we artificially shut down supply. So when you have that supply-demand imbalance, you're going to get inflation. Well, the opposite side of that coin is that now the consumer is beginning to slow down, and consumers are basically what provide the demand side of the equation. And we have to produce first before we can consume. We have to go to work. We have to earn a paycheck before we can go buy anything, right? So we have to produce first, then we consume, and then ultimately that demand from the consumption is what's going to drive inflation based on our demand for goods or services, whatever those are. Well, if you're watching what's going on with retail sales, what's going on with employment, what's going on with jobless claims, those type of things, that is already telling you that the demand side of the equation is slowing down. So again, one thing you have to factor in is that inflation doesn't materially just show up out of nowhere. There are some artificial inputs that can impact inflation, as we saw with stimulus checks. But given a more organic environment, which we have returned mostly back to, right? There's still a few of those artificial stimulus inputs still sitting out there, but for the most part, we're back to a more organic, natural environment of supply and demand. And if the economy is slowing down, inflation is going to ultimately begin to slow down with economic growth because they are simply a function of one another. Real quick, before we get to the break, we'll come back and we're going to pick up with Michael Lebowitz and talk a little bit about dividend investing this morning, about how to find dividend stocks, what to look at. Mike's a CFA. He knows all this stuff, so that's that. By the way, I was in Greece recently for my family vacation, and I bought, we have Brent likes tchotchkes. We have all these tchotchkes around our studio. And so this is we were asked by Andrew that, this is a Spartan helmet, and this is his warning that if he messes up my charts, we are Sparta. Right. So, all right. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. I got an interesting email earlier this week asking about dividends. And basically the email states that I'd like to hear about evaluating a company for dividends as for the lower risk part of the portfolio. And it's a good question, and one that I see so many mistakes that people make when people send me portfolios or we bring on a new client, whatever it is. You can see how their investment style is by the stocks that they own. And one of the most common mistakes that I see in dividend investing, which typically has poor outcomes long-term, is buying stocks because of the yield, right? It's like, oh, I bought this stock because it has a really high yield. The yield is the least important thing about dividend investing. And because yield as a function can tell you two things. One, if it's got a high yield, you have to ask the question, why is the yield so high? It may be because the company's in trouble and the prices follow, because yield is simply a function of the dividend, what the dividend is. So if a company pays $1 in a dividend and it trades at $10 a share, it's going to have a 10% dividend, right? At $100 a share, it's a 1% dividend. So you've got to be careful with what the yield is telling you, because it may signal trouble for the company. And this is why just buying it based on the yield often turns out bad. A great example here just recently was Intel. Intel had a big yield on it, but if you took a look at the stock price, it told you there was some trouble with the company, but a lot of people were buying Intel because of the yield. And now The problem is that the stock's gone down another 20%, and now there's no dividend, right? So now they've cut the dividend. So now there is no yield, and the stock price is still going down. So yield can tell you a lot about the company. So just focusing on yield alone, it can often be a big mistake. It's like value stocks, right? There's two ways to look at a value stock. There are stocks that are of value because they're a value, and there's stocks that are called a value trap. They look like a value, but they're a trap. And Mike and I have gotten caught in those more than once, right? CVS was one of our great examples of a value trap that we got stuck in
over and over again.
But we keep trying. Damn it! I'm sure it's a value stock, but that's a great example. Look, we all make mistakes, right? Nobody's perfect. No investor gets it all right. But let's talk a little bit, Mike, about things that so just as you, not as our portfolio management goes, because we just buy stuff that goes up. That's our whole philosophy. I'm joking. But if you're looking at a dividend stock, what are some of the or you're looking to buy a stock that has a dividend and you're looking to build a dividend income portfolio, what are some of the things that you're going to be looking for specifically to try to determine if that dividend that you're buying is both safe and potentially lasting?
So for me, the way to think about dividend is it's kind of a trade-off between dividend and growth. So if you look at one extreme, like Philip Morris or Altria, tobacco companies, there is virtually zero growth in both of those, earnings growth in both of those companies. They're in the tobacco business, so they're just paying out their earnings to their shareholders. They're not growing, they're not pretending to grow. So you own a cash cow, which is basically just spitting out cash. But when you start going out the spectrum, you own an NVIDIA. NVIDIA could boost their dividend easily to 5%. But if you own NVIDIA, do you want them paying out money that they've earned to shareholders, or do you want them investing into their future? So that's a growth company. And you want growth companies to be, in theory, investing in their future because that growth rate is higher than what you can earn at in the bond market or in a corporate bond market. So it's a trade-off between earnings and growth when you're kind of looking at the whole spectrum of companies. So one of the key statistics that I think is important is what's called the PEG ratio. So all you do is you take the price to, and this helps compare companies. So you take the price to earnings ratio and you divide it by a 3 or 5 year earnings growth rate. So if a company has a PE of 17 and they expect their earnings to grow at 17%, it's got a PEG ratio of 1. And typically you want to see a PEG ratio below 1, but many companies are above 1. And the higher the PEG ratio, and then what you can do is compare companies. So you can say, well, Philip Morris has a PEG ratio of 1. NVIDIA has a PEG ratio of 0.9. So even though NVIDIA has a much higher price to earnings ratio, its growth rate is much higher than that of Altria. So you need something to compare companies. The other thing that I think is very important is, and what you just said about Intel, can they continue to pay their dividends? And what most analysts do with that is look at operating cash flow. So how much cash, not earnings, not revenue, but just cash, how much cash is circulating through that company? Is it enough to pay for their interest and their dividends? And also growth. And you can easily look at a ratio that's basically operating cash flow compared to dividend payouts. And if operating cash flow is rising faster than dividend payouts and there's a positive gap between the two, that's a good sign. That means they have money for dividends and they're still accumulating cash, which can be used for either higher dividends or for investing in their future earnings. So, I think for me, the bottom line is you're making a trade-off between growth and cash payments. And depending on the type of company, some companies you just want the cash, right? We don't need Altria or Philip Morris investing. because they have nowhere to go, nothing to do unless they enter a new business. And then what expertise do they have if they enter the auto business? So let them do what they do well, and that's making tobacco products, and spit the dividends out to investors. And something like NVIDIA or these high-tech companies, keep investing in yourself. You've been doing a great job. Keep doing that. Don't give me the money. Put it to work, the way you've been doing it, because you're making a lot more in earnings growth than I can make in any kind of fixed income or even S&P 500 growth. So, and then, again, there's a whole spectrum of companies in between that are, they're growing a little bit more than Altria or a little bit less than NVIDIA and in between. So, from a high level, that's kind of how I think about it, Lance.
Yeah, and I think that's, and again, you've got to be, there's a lot of factors that can go into this, Mike, and we're talking about specific companies right now, like, for instance, like an Altria or a Philip Morris. And, there's kind of two parts, to that story, but then there's some other things that also pay yield that require a whole different kind of set of analysis, and something like an agency, like a mortgage REIT, right? Mm-hmm. That's a different set of dynamics. So if I was going to look at and again, those tend to attract a lot of investors because they typically do have high yields on them. Also like an AMLP as an example, an MLP kind of an ETF, right? Those have higher yields. So if I was going to look at an agency REIT as an example, would I still use the PEG ratio for that, or would there be some other thing I want to look at specific to that area?
No, with that, so an agency REIT is a REIT, and there's 4 or 5, there's probably even more. Annaly is another big one, and what they do is they issue stock, so they have equity. They borrow money, and they use that money to hold a mortgage portfolio. It's a leveraged portfolio of mortgages. And they hedge that portfolio, and it's their job to basically, because it's structured as a REIT, they pay out a dividend that's equal to at least, I think it's 90% of what they make. So it's structured very differently. So what you're looking at with like an agency REIT, for instance, is what's the mortgage market doing? What's the price of Annaly compared to the net asset value of its portfolio? Is it overpriced? Is it underpriced? Because at times when it's overpriced, the agency REIT will go issue more shares to boost their equity so they can borrow more and they can make their company bigger. So, there's a lot that goes into it. In a pipeline, an energy pipeline, you're looking at flows and where's their business structured and how much are they getting for the flows that go through their pipelines? And, so there's a lot more. Altria is kind of easy, right? It's the tobacco business. Earnings are growing at a very slow rate, but it's very predictable. A lot of these other kind of special dividend plays that are related to a very particular business segment, you have to be careful to understand what they do, when's a good time to buy it, when's a bad time to buy it. Because, look, a lot of these pay double-digit dividends, but they can easily go down 10, 15, 20% in a year, too, and leave you high and dry.
Yeah, and then we'll take a quick break. I want to come back. I want to finish up on this conversation because there's a lot of other mistakes that investors tend to make when investing in dividend-yielding stocks. And one of those things I just want to talk about is going back to the dividend versus the dividend yield. And sometimes we get distracted between, the dividend yield. It's like the shiny object in the window, but we miss out on what the importance is what we're actually going to get in terms of cash, which is the dividend payout. We'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a couple of other things real quick that I just want to cover on this dividend side of the equation is the same thing that we talk about in bonds. Mike and I discussed a little bit this last week. What's better? A bond that pays a 1% coupon that's trading at 80 cents on the dollar that's going to mature in a year, or a bond that's trading at 7% that's also going to mature in a year, but you're buying it at a premium, right? And we went through that analysis last week and saying, look, just because what's not important is the coupon, right? The coupon tells you that's just the stated payment. The yield on bonds is more telling because it's a function of the price you pay versus what you're going to wind up at maturity. But that's with bonds. So in bonds, looking at the yield is more important than looking at the coupon. However, it's the inverse in stocks. A good example of this is we all when buying dividend yielding stocks, we get wrapped up in the yields. Like, oh my gosh, this thing has a 7% yield on it, so I want to buy it. Well, what we miss is what is the company actually going to pay me? Because the yield is just a function of the coupon of the dividend payout, the actual dividend, the cash dividend, by the price. So that's the yield. Good example of this, and I'm gonna set Mike up here to talk about this, but let me just give you two quick stocks real quick. So what's better? A stock with a 5.5% or 5.7% yield on it, or a stock with a 3% yield, right? And so initially you say, well, I want the higher yield, right? So that's AT&T. The problem with AT&T is that's great. It's got a 5.7% yield, but it only pays out $1.12 a year per share. So if you own one share of AT&T, you're going to get $1 a share, $1.12 a share by the end of the year. If you own ExxonMobil, right? One share of ExxonMobil, you're going to get $3.85 for that same share at the end of the year. So what was better? What actually did you make more money on? And so one of the things you've always got to look at is it's not always about yield. And again, we all get wrapped up in the yield a lot of cases, and that's where we start, as we were talking about earlier, that's where we start winding up in, buying stocks that have cash flow issues, or they have earnings growth issues, or there's a reason that sometimes yields are high on stocks, and you've got to understand why is that yield so high, right? And that's and again, part of the issue, as we talked about before, is it's great to own a dividend yielding stock, and one of the biggest mistakes I see people make all the time is, well, I own it for the yield. I don't care what the price does. You will care about the price. It's easy to say that when the stock price is doing okay, or even if it's stable, but you're going to care when it loses 50% of its value at some point. And so that's where, like with Intel's a good recent example, but Intel's not an anomaly. We've seen this happen over and over and over again over the last 30, 40 years. Stocks lose a tremendous amount of value, and then they cut their dividend, and that whole dividend thesis just went out the window. And again, you wind up selling these things at low. So Mike, I'll stop there. But that's kind of one of the mistakes I see people make a lot, is chasing the yield versus paying attention to what they're actually receiving in cash.
Right. Just let me add one thing to that. It's how did the yield get there? So I don't know what Intel's yield was before they cut the dividend, but I'm guessing it was probably 7, 8, 9%.
Yeah, it was up there.
And it wasn't up there because the dividend payment was going up. It's up there because the stock was plummeting. So, the one of the big things to ask yourself is, where's the dividend yield? Where's it been? And why is it getting there? Is it getting there because the stock price is rising and you're increasing their dividend? That's great. Or is it getting there because the stock price is going down and their ability to pay the dividend is declining? But they did pay the dividend last quarter. And a lot of times when they calculate these yields, they look at the last 4 quarters. So a company could be on the ropes, but they did make their payment the last quarter. That doesn't mean they're going to make the next payment or the payment after that. So you just have to be careful. And just because something, we talk about this all the time in bonds. If something has a very high yield, there's a reason for it. It's the same with stocks. If something has a very high yield, there's a reason. One reason just may be there's no growth. But the other reason is something like Intel, that they have real material problems, and it's highly likely they're not going to make that dividend payment. And even if they make 1 or 2, that's great, but you could lose 10, 20, 30, 40% in the stock price, which would, much more than offset whatever dividend payment you get.
I want to switch gears real quick to, we had a good question in chat about this as well. And this is something that, with the advent of ETFs, everybody comes out now with an ETF that, for everything, right? Now, I was just doing a screen as an example for high yielding stocks because I was just wanted a couple of examples to work with. And, one of the stocks that came up was a Granite 2X leveraged Apple ETF. It is an ETF that owns Apple. That's all it owns, and it's leveraged 2-for-1. So it has a high yield because of that leverage. So we see a lot of these advents, and the more demand there is for income, and again, this has been an issue that we've seen really, rising over the last decade because of zero interest rates by the Federal Reserve, low interest rates in the environment, low interest rates on, zero interest rates on money markets. The chase for yield has created a lot of demand for yield generating products. One of those that's really come to focus as of late over the last few years and has really gained a lot of popularity over the last couple of years in particular are these covered call ETFs. And it's a good question in the chat, and I appreciate you bringing that up because, I get a lot of questions about these covered call ETFs, like, oh, this is, I can buy this, ETF, and there's one, for instance, on the NASDAQ 100, and I think it yields 10 or 11% right now. And it's just basically generating income from the covered call writing. So as I write a call on something, right, I generate premium for that. And if I'm writing calls large enough on that type of an index, as an example, I can generate a large chunk of premium for that, and I can create that outsized level return. The problem is twofold. One is, and I'm going to turn this over to Mike here right as soon as I say this, but the first problem is if you take a look at the relative performance, it's terrible. And that's what you would expect it to be because I'm buying a stock, a covered call stock ETF or a covered call, index ETF. When I write those calls, I'm limiting my upside because if the price rises and it goes above the call strikes, I get called away. So I've got to sell those shares. So it's a hedge, right? When you do cover call writing, it is a hedge, but you also limit your upside because you're constantly getting called away if you're in a bull market. So you should expect that your performance is going to be pretty bad relative to the overall index. As there is always the case, there's no free lunch. You don't get a 12% yield and stock market returns. It's just that's not going to happen. The other problem comes back to volatility, and volatility is what drives premiums. And so the issue of, yes, it may be paying a 12% dividend right now or a 10%, whatever it is, it doesn't mean that's going to always be the case in the future, because volatility drives premium values on option writing. Mike?
Yeah, so first of all, there's a huge difference between dividend ETFs and covered call ETFs. Dividend ETFs holds dividend stock, high dividend stocks. Covered call is a portfolio of what Lance just said. They own stocks and then they sell calls at a higher price on those stocks. So if the stock is going up, it's great because you make a little bit of income when they sell the call, but you're missing out on upside. And if the stock goes down, you go down with it. The only difference is you made some of that income from selling the call. So the downside is a little buffered, and the upside is limited. So in an upward trending market, those usually aren't good strategies. The other flaw with it is in an upward market, volatility tends to be lower in price. And volatility is what determines one of the big components of how you price options. So, prior to the recent volatility we've had, volatilities were basically near record lows. So anyone doing this strategy was getting very low premiums for writing calls and eliminating their upside, which is exactly what you didn't want to do over the last, 9 months or a year.
Yep.
So again, we do on occasion write covered calls on particular stocks. Those tend to be stocks that we are comfortable with, but we'd be happy selling at 5-10% higher if our call gets strikes, and that's great. And if it doesn't strike, that's fine too, because we still like the stock, but we'll take the income from the call as additional income. So, as far as ETFs that do it, I'm not so fond of them, but doing it on a one-off basis when it makes sense, when you know what the volatility is, what you're getting paid, if you're comfortable giving up on the upside and comfortable taking on, you're not really eliminating much downside. So again, two different products, but they do both produce income to some degree.
Yeah. One of the ETFs that come up on this is often, and I get emails on this all the time, and it was just brought up in the chat as well, is the JP Morgan Equity Premium Income ETF. It's a great example of exactly what we're talking about. It's an ETF that owns stocks that they write covered calls on, and it has about a 6% yield. So that's been great, right? It's been getting a 6% yield on this covered call writing. The problem is it's still 50% lower than where it was back in 2020, back at the peak of the market in 2022. So it's had a big decline, going through the bear market. It's rallied back about half of that decline that it had, and is nowhere near making an all-time high, while the rest of the market around the world is taking off to the moon, right? So again, performance, great. I got a 6% yield. That's awesome, but I've really, really lagged on performance. And so when you're dividend investing, the goal, and this is why our dividend model is built this way, the dividend equity model is designed to provide a higher yield in the market, but also provide market-related performance, because that's what generates your total return over time. All right, that wraps up the show for today. Mike, thank you so much. And we'll be back tomorrow with Rich and Danny for Financial Fitness Friday. Have a great day.